Welcome to Market Brief After Hours. It has been a turbulent week on Wall Street and across the globe. We are seeing a deepening market sell-off, surging oil prices, and escalating tensions in the Middle East, pushing investors firmly into a risk-off mindset. We have a lot of ground to cover today, from major U.S. indices slipping into correction territory to wild moves in the Forex and crypto markets. To make sense of it all, let's dive right in. What is the overarching theme driving this massive global pullback?
The dominant force right now is pure geopolitical uncertainty, specifically centered around Iran and the closure of the Strait of Hormuz. When a major global shipping artery shuts down, energy markets panic. We are seeing physical supply constraints and fears of prolonged disruptions. That panic is bleeding directly into equities. Investors are realizing these are not just short-lived headlines. There is real economic fallout here, especially with oil prices hitting multi-year highs.
Let's put some numbers to that pain, starting with the U.S. indices. The bleeding looks severe across the board.
It really is. The Dow Jones Industrial Average officially entered correction territory. It fell 793 points, or 1.73%, to close at 45,167. That marks a roughly 10% decline from its peak. It is a stark reflection of deteriorating risk sentiment.
And the broader market isn't looking much better, is it?
Not at all. The S&P 500 dropped 1.67% to close at 6,369. That is a 7-month low. It also marks the 5th straight weekly decline for the index, which is down 2.1% over the week and about 8.7% below its record close. It is a very broad-based pullback.
What about the tech-heavy Nasdaq? Tech usually takes a beating when risk appetite vanishes.
Exactly. The Nasdaq slid deeper into correction, falling 2.15% to close at 20,948. It lost 3.2% on the week, leaving it nearly 13% below its October high. We are seeing sustained selling pressure across major growth stocks, which are highly sensitive to the kind of inflation fears that surging energy prices bring.
Speaking of energy, just how high did oil prices jump?
The rally was sharp. U.S. crude surged 6.16% to $100.30 per barrel, and Brent crude climbed 5.60% to $114.06. Those are the highest levels we have seen since July 2022. Even with the U.S. extending the deadline for military action, the market is entirely focused on the physical supply risks and shipping route disruptions.
That kind of pain at the pump usually hits the consumer hard. Are we seeing that in the macroeconomic data yet?
We are, and it is alarming. The University of Michigan's Consumer Sentiment Index fell sharply to 53.3 in March 2026, down from 56.6 in February. That leaves confidence near the record lows we saw at the end of 2025. The decline is broad-based across all age groups and income brackets. The short-term economic outlook dropped 14%, and expectations for personal finances over the next year fell 10%. Households are incredibly uneasy.
With equity selling off and oil surging, how is the bond market digesting all this?
Treasury yields are mixed, which perfectly captures the tug-of-war between safe haven buying and inflation fears. The 10-year Treasury yield edged slightly higher to 4.432%, and the 30-year yield rose to 4.973%. However, the 2-year yield actually fell 8 basis points to 3.904%. Investors are really struggling to balance the risk to global growth against the reality of energy-driven inflation.
It is not just a U.S. phenomenon, though. European markets are taking a significant hit as well.
Yes, the sell-off in Europe is incredibly widespread. The STOXX 600 fell 0.9%, with almost every sector closing in the red. Looking at specific countries, Germany's DAX dropped 1.41%, Italy's FTSE MIB declined 0.74%, and Switzerland's SMI fell 0.57% to 12,570. Over in the UK, the FTSE 100 edged down 0.12% to 9,961.
What is driving the localized pressure in those European nations?
It is a combination of those persistent geopolitical risks and softer economic signals. In the UK, retail sales contracted 0.4% in February, and car production fell significantly, with exports dropping 11.5%. Meanwhile, Spain saw its inflation accelerate to 3.3%, adding to regional pressures. And of course, the ongoing G7 discussions in France are heavily focused on the situations in Iran and Ukraine, keeping everyone on edge. Eurozone inflation expectations have eased to 2.5% over the next 12 months, but growth expectations remain totally subdued.
Did we see that same pressure carry over into the Asian and Middle Eastern markets?
It was a bit more mixed there, as investors assessed conflicting signals on U.S.-Iran negotiations. In India, the Sensex took a hard hit, falling 2.25% to 73,583, and the Nifty 50 dropped 2.09%. Japan's Nikkei 225 slipped 0.43%. But on the flip side, China's CSI 300 actually rose 0.56% to 4,503, supported by strong industrial profit growth of 15.2% year-over-year.
And the Gulf region itself, right in the middle of the geopolitical storm.
Performance there diverged sharply. Oman is up 9.3%, and Saudi Arabia is up 5.8% since early March, largely benefiting from the oil surge. But Dubai has plummeted nearly 16%, showing severe sensitivity to geopolitical risks and its heavy real estate exposure.
It is a complex web of macroeconomic pressures right now. We are going to take a quick break, but when we come back, we will dig into the Forex markets, including some critical moving averages you need to watch, and highlight the biggest market movers of the day. Stay with us. Welcome back to Market Brief After Hours. Before the break, we mapped out the global equity sell-off and the surge in oil. Now, let's pivot to the currency markets. There is a lot of technical action happening there today.
There really is, particularly with the US dollar pairs. Let's look at the euro against the dollar. Euro USD closed at 1.1517, down 0.10%. What's critical here is that bearish pressure is persisting. The pair is trading well below its key moving averages. The 50-day simple moving average is at 1.1723, the 100-day is at 1.1688, and the 200-day is at 1.1676. All of them are trending lower, reinforcing a sustained bearish bias. Price action is trapped in a sequence of lower highs and lower lows.
And the British pound?
A very similar story. GBP USD closed at 1.3272, down 0.44%. The downtrend is fully intact. It remains firmly below its 50-day SMA at 1.3502, its 100-day at 1.3412, and its 200-day at 1.3432. Selling pressure dominated the session, pushing the price toward the lower end of its range. Immediate support rests at 1.3260, and if that breaks, we are looking at the 1.3200 psychological level.
But the dollar isn't dominating every pair. What is happening with the Swiss franc?
That is the outlier. USD CHF actually broke higher, closing at 0.7987, up 0.53%. Bullish momentum is really building there. It broke above the 200-day SMA at 0.7944 and continues to trade above the 50-day at 0.7788 and the 100-day at 0.7888. Buyers are firmly in control as it approaches that 0.8000 level.
With all this risk-off sentiment, how are the traditional safe havens like precious metals holding up?
They are doing exactly what you would expect in a crisis. Gold rebounded sharply, closing at $4,512, which is a massive 2.98% jump. It tested its 200-day SMA at $4,095 and bounced right off it, proving that long-term support is intact. It is still below its 50-day and 100-day averages, but the broader structure is very constructive. Silver also had a great day, closing at $70.06, up 2.89%. It is holding well above its 200-day SMA of $57.52, preserving its longer-term bullish trend and potentially forming a higher low.
Let's shift gears to the digital asset space. Bitcoin had a rough session today.
It did. Bitcoin slid 4.3% to $65,997, hitting its lowest level in over 2 weeks. The big catalyst here was the expiration of roughly $14 billion in options contracts. Once that positioning support was removed, traders were left facing the reality of war-related uncertainty, higher oil prices, and persistent inflation. Positioning data turned very defensive. Open interest is now concentrated around $60,000 put options, and the put-to-call ratio rose to 1.3. People are actively seeking downside protection.
I imagine that dragged down the crypto-linked stocks as well.
Absolutely. Riot Platforms and Galaxy Digital dropped more than 8%. Coinbase and Mara Holdings fell over 6%, and Strategy declined more than 5%.
It was a clear risk-off shift for anything with digital asset exposure.
We also saw some major movement in the tech sector today, starting with cybersecurity. What triggered the sell-off there?
There was a broad scare after reports surfaced that Anthropic is testing an advanced AI model that could actually introduce new security risks. That sent a chill through the entire sector. Palo Alto Networks and CrowdStrike each fell about 6%, SentinelOne dropped 6%, and Datadog slid 8%. Investors are taking a very cautious approach to potential AI-driven disruption in cybersecurity.
The mega-cap tech stocks didn't offer any safety nets either.
No, the Magnificent Seven added significant pressure to the indices. Amazon and Meta platforms declined more than 3%. Nvidia, Tesla, Microsoft, and Alphabet all fell over 2%, and Apple closed lower by more than 1%. It was just broad-based weakness across large-cap technology.
It sounds like a sea of red. But were there any bright spots moving the market today?
Surprisingly, yes. Argan was a massive standout, surging 38%. They reported fourth-quarter earnings of $3.47 per share on $262.1 million in revenue. That completely blew past expectations of $1.98 per share. Unity Software also had a stellar day, jumping more than 13%. They released preliminary first-quarter results showing incredible strength in their AI-driven vector advertising segment. So companies executing well on AI monetization or delivering massive earnings beats are still getting highly rewarded.
That is a fascinating takeaway. It seems the broader market behavior has shifted from short-lived volatility to sustained caution. Investors simply are not willing to overlook geopolitical risks or surging energy prices anymore.
That is exactly right. Weakness in equities, combined with defensive positioning across bonds, commodities, and crypto, highlights a massive rotation away from risk. Elevated oil prices are clouding the outlook for growth and inflation. Looking ahead, the market is going to remain highly sensitive to developments in the Strait of Hormuz. Without clear progress on the geopolitical front or some stabilization in energy markets, any rallies are likely to face heavy resistance.
We will certainly be watching those developments closely. Thank you for breaking down all of these complex moving parts today. If you find this useful, please follow Market Brief after hours.